Hi everyone, it's John Maxson with Beacon Capital Management. In today's teaching, we're going to talk about what can be one of the most controversial topics in financial planning today, and that is the topic of annuities. You know, we get a lot of phone calls in our office, and some people will call us and they'll say, I was watching TV today and I saw an ad and I was watching a financial professional and they said that they hate annuities. And then a few minutes later, I was watching another ad and this person came on the news and they said that they loved annuities. So how do annuities work? What are the different kinds, and should you consider one of them? Well, the truth is that's going to be different for everyone out there today. But when you approach the topics of annuities, there are actually several types and many different features that you should consider. So what is an annuity? Well, at a basic level, an annuity is by definition a term that means to guarantee income. They are investments with insurance companies, and there are four typical types of annuities that are out there. The first type is what is referred to as an immediate annuity. And many of you, or some of you out there, probably have an immediate annuity right now, and you may not know that. What is an immediate annuity? Well, all pension plans, for example, in America today, if you're fortunate enough to have a pension, well, they are immediate annuities. You retire, and then at a certain point, you begin to get a check, and that check lasts you, it's sent to you each month, and it lasts you for the rest of your life. So all pension funds in America today are a form of an annuity referred to as an immediate annuity. And then there are three other types with different features as well. The second type, and one of the most common ones that tends to have more controversy around it, is what's called a variable annuity. And a variable annuity is exactly like it sounds. It's an investment with an insurance company that has a sub-account of mutual funds, essentially, that can go up with the market or go down with the market. So it's variable. It can go up and down. And along with your balance or your account balance going up and down, there can be additional riders that are put on that annuity. So what are some of the features? Well, some annuities out there have lower fees and some have higher fees. Variable annuities, for example, typically have higher fees than some of the other annuities that are out there. And so if you have a variable annuity, you certainly want to understand what your fee structure is, in addition to the fact that your account value can go up and down. You can have in a variable annuity a feature like a guaranteed income stream. And so think of riders as almost like an a la carte menu. You can add different riders to annuities, variable annuities, and some fixed index annuities that allow you to have things like an income rider. An income rider is like a bucket of money that you're pouring money into this bucket, and this bucket has a spigot on it that at a future point you're going to turn an income stream on, that the insurance company is giving you a contractual guarantee that they're going to provide income for the rest of your life. So one of the other things we would say to you about any annuity company is they are not FDIC insured. That doesn't mean that they're not a safer investment. It means that you need to understand the rating and the solvency rate of any annuity company that you may consider. But variable annuities, again, are an annuity that goes up and down with the market, and you can add different features or riders. And the more features or riders you add, the additional costs typically go up. The third type of annuity that is out there is a fixed annuity. And a fixed annuity is really a simple, straightforward investment. Again, with an insurance company, it functions a lot like a bank CD. Now, the big difference is an annuity is not FDIC insured like a bank CD, but a fixed annuity is just a simple declared rate of return. So, for example, you might do a 5-year fixed annuity that has a declared rate of 2.5% to 3% potentially. And if an insurance company agrees to provide 3% a year for 5 years, that's your declared interest rate. That's what you're going to make. Your principal is protected, and you will get this declared rate of return. And then at the end of that term, whether it's 3 years, 4 years, 5 years, that money is liquid, and then you can go on and reinvest that in another fixed annuity, or you can take it and do something else with it. So the difference between a fixed annuity or a fixed index and a variable is they are principal protected. So it's a fixed investment where your principal is protected. Now, the fourth type is what's called a fixed indexed annuity, sometimes referred to as a hybrid annuity. But the way a fixed indexed annuity works is that your money is not directly invested in a stock market index like the S&P 500 or the NASDAQ. However, how much interest you make each and every year is based on how the underlying index or strategy does. So for example, your money is principal protected from the day that you start, again backed up by the paying ability insurance company. If you're following, for example, the S&P 500, if the S&P 500 goes up, your account value in a fixed index annuity is going to go up with that index, but not as much as the index. This is a more conservative investment. There is a trade-off, or it's commonly referred to as a cap. So if the market goes up, you're not going to get all of the return of the market. However, if the market goes down, you don't lose anything in the account because it's a principal protected investment. And so there are different terms. Some of them are longer term, some of them are shorter term. What we're looking for if a client does a fixed or a fixed index annuity is what we would refer to as a reasonable rate of return. We're not looking to keep up with the market. We're looking to give you some principal protected money and you to be allowed to participate in some of the market gains without losing money in the downturns. A couple of other things that I would point out is that some of these annuities out there have long-term care riders or death benefits that can be used in the event that you end up having a catastrophic illness or something like that. Again, these are riders and things that you need to understand. And then you want to make sure that if you add an annuity as part of your portfolio, that you have adequate liquidity, because most annuities out there give you partial liquidity but not full liquidity. So you want to make sure that the money that you have is sectored out so that you have adequate liquidity for income and various needs that you may need in your financial life. So annuities, yes or no? Well, the truth is, depends on your situation. In any investment, annuities or otherwise, you need to make sure that you understand what the trade-offs are, what the risks are, and what the potential rewards are. If this is something that you'd like more information about, you can contact our office and we'd be happy to give you some additional information. A lot of times we run into folks who have annuities and may not understand these various aspects. Happy to do a free annuity review for you and your family. And lastly, I would say to you that if you like what you're hearing this channel, subscribe to our YouTube channel. We're going to continue on a various amount of topics doing educational videos like these. Thank you very much for your time today.